October 31, 2008, an anonymous programmer using the name Satoshi Nakamoto published a 9-page white paper titled Bitcoin, a peer-to-peer electronic cash system. The opening sentence promised a revolution. A purely peer-to-peer version of electronic cash would allow online payments to be sent directly from one party to another without going through a financial institution. Read that again, without going through a financial institution. The entire purpose of Bitcoin, stated explicitly in the first sentence, was eliminating banks, payment processors, and Wall Street intermediaries from financial transactions. Fast forward to January 20th, 2026, exactly 2 years after SEC approval. BlackRock's iShares Bitcoin Trust holds 784,424 Bitcoin valued at approximately $70 billion. BlackRock, the world's largest asset manager, controlling $12.5 trillion, now controls more Bitcoin than any entity except Satoshi Nakamoto, charges 0.25% annual management fees for custody, and recorded its largest single-day inflow ever on January 14, 2026, at $648 million. The technology designed to eliminate financial intermediaries now has more intermediaries than traditional finance ever did. And Wall Street extracts billions in fees from assets explicitly created to destroy Wall Street's rent-seeking business model. This is the story of how Bitcoin went from cypherpunk rebellion to being captured by the exact institutions it was created to destroy, why Wall Street waited for adoption before moving in, and why understanding this pattern reveals that empires don't fight threats. They co-opt them and turn rebellion into profit centers. Let's start with what Bitcoin was supposed to be. The cypherpunk movement of the 1990s believed cryptography could create freedom from government and corporate surveillance. Key figures like Timothy May, Eric Hughes, and Wei Dai wrote manifestos about using encryption to build parallel economies beyond state control. They wanted anonymous digital cash that couldn't be censored, frozen, or seized. When Bitcoin launched in January 2009, it was adopted first by cypherpunks, crypto-anarchists, and libertarians who'd been waiting decades for working implementation of digital cash beyond state control. The early Bitcoin community discussed Austrian economics, debated the evils of central banking, and genuinely believed they were building alternative to the Federal Reserve and Wall Street. Satoshi's own writings referenced the bank bailouts with contempt. The Genesis block contained the message, the Times 03/Jan/2009, Chancellor on brink of second bailout for banks. This wasn't subtle. Bitcoin was explicitly positioned as response to financial system corruption. The ideology was pure. Be your own bank, control your own money, eliminate trusted third parties, hold your private keys. Not your keys, not your coins became the mantra. Early adopters ran full nodes, mined Bitcoin on personal computers, traded peer-to-peer without exchanges. When Bitcoin hit $100 in 2013, the community celebrated because it proved the system worked. A decentralized currency achieved real economic value without government or corporate backing. This was supposed to be financial sovereignty for individuals, the obsolescence of Wall Street. The vision was beautiful, technically sound, and completely naive about how power actually works. Here's the first crack that allowed Wall Street's entry. Most people can't secure private keys. The technical reality of Bitcoin ownership requires understanding public key cryptography, generating random seeds securely, storing 12 or 24-word backup phrases safely, using hardware wallets correctly, taking sole responsibility for security with zero recourse if anything goes wrong. Lose your seed phrase, lose your Bitcoin forever. No customer service, no password reset, no recovery. Survey data from 2017 showed approximately 30% of Bitcoin had been lost forever, sent to wrong addresses, stored on dead hard drives, forgotten passwords. Billions of dollars permanently destroyed because users made mistakes. The average person cannot be trusted to secure life savings using cryptographic keys they don't understand. This created the opening for trusted third parties, the exact thing Bitcoin was supposed to eliminate. Exchanges became the Trojan horse for institutional capture. Coinbase launched in 2012, offering simple interface. Sign up with email, link bank account, buy Bitcoin, and Coinbase stores it for you. No private keys to manage, no technical knowledge required. This was essential for adoption, but fundamentally betrayed Bitcoin's core premise. When Coinbase holds your Bitcoin, you don't own Bitcoin, you own an IOU from Coinbase. They control the private keys. They can freeze your account. They comply with government subpoenas. They operate exactly like a bank. Not your keys, not your coins became, let Coinbase custody your Bitcoin because self-custody is too hard. By 2026, Coinbase serves as primary custodian for BlackRock's IBIT and multiple Bitcoin ETFs, holding hundreds of billions they control on behalf of investors who never touch private keys. The majority of Bitcoin owners don't actually control their Bitcoin, they trust centralized custodians. This is the first layer of capture. Users voluntarily gave up sovereignty for convenience, recreating the trusted third-party system Bitcoin was designed to eliminate. But here's where capture accelerates. Institutional investors, pension funds, endowments, wealth managers can't custody cryptocurrency themselves. Fiduciary responsibility and regulatory requirements demand professional custody. So institutional investors needed specialized cryptocurrency custodians meeting traditional finance standards. Enter Coinbase Custody, Anchorage, BitGo, institutional-grade custodians charging basis points on assets under management. BlackRock doesn't hold Bitcoin directly, they contract with Coinbase Custody. The result, hundreds of billions in institutional Bitcoin held by small number of custodians creating centralization points vulnerable to regulation and seizure. The decentralized cryptocurrency is now custodied by centralized institutions that can be pressured by governments exactly like banks. The ETF approval on January 11, 2024 was the final capture. Before ETFs, buying Bitcoin required opening exchange accounts, going through KYC verification, managing custody decisions. ETFs solved this. Buy Bitcoin exposure through regular brokerage account using existing infrastructure. No cryptocurrency exchange needed. No private keys. Just buy IBIT like buying stock. Convenience is the mechanism of capture. But here's the extraction. BlackRock charges 0.25% annual management fee. Fidelity charges 0.25%. Grayscale charges 1.5%. These are fees for doing essentially nothing except holding Bitcoin in custody. A traditional Bitcoin holder who self-custodies pays zero ongoing fees. An ETF investor pays 0.25 to 1.5% annually forever. Scale this across BlackRock's $70 billion in IBIT assets as of January 2026, generating $175 million in annual fees just from this one fund. Multiply across all Bitcoin ETFs holding approximately $128 billion total assets in mid-January 2026, and Wall Street extracts $320 million to $1.9 billion annually in management fees from assets designed to eliminate financial intermediaries. But fees are just the beginning. ETF shares are not Bitcoin, they're derivatives representing Bitcoin ownership. The sponsor holds the actual Bitcoin. Shareholders own shares of the fund. This creates separation between Bitcoin ownership and Bitcoin control. As of January 16, 2026, BlackRock's IBIT alone holds 784,000 Bitcoin, approximately 4% of total Bitcoin supply controlled by single Wall Street institution. All Bitcoin ETFs combined hold approximately 606,000 to 1.3 million Bitcoin, roughly 6 to 7% of all Bitcoin ever mined. If Coinbase custody faces regulatory pressure or security breach, hundreds of billions are vulnerable. The decentralized cryptocurrency is now dependent on centralized custodians operating under traditional financial regulations. This is exactly what Bitcoin was supposed to prevent. Here's Wall Street's perfect capture strategy. Phase 1, ignore and dismiss 2009 to 2013, call Bitcoin a scam, rat poison. This kept traditional finance investors out, allowing early adopters to accumulate, and positioned Wall Street as skeptical outsider. Phase 2, build infrastructure 2013 to 2017, create exchanges, custody solutions, payment processors. Companies like Coinbase built traditional finance-style infrastructure, got Wall Street funding, hired Goldman Sachs and JP Morgan executives. Phase 3, Regulatory capture, 2017 to 2023. Lobby SEC for ETF approval. Position institutional custody as necessary for investor protection. Create compliance frameworks making self-custody legally risky. Phase 4 product launch, January 2024. ETF approval allows Wall Street to offer Bitcoin through traditional channels, charging traditional fees, maintaining traditional control. By waiting until Bitcoin achieved legitimacy, Wall Street entered at moment of maximum profit with minimum risk. The statistical reality 2 years after ETF launch is stark. By mid-January 2026, BlackRock's IBIT has attracted cumulative inflows exceeding $24 billion since launching January 11, 2024, the fastest-growing ETF in history. Total Bitcoin ETF assets sit at approximately $128 billion. The week of January 12 through 16, 2026, saw $1.4 billion in net inflows, led by BlackRock's $1 billion. On January 14 alone, IBIT recorded $648 million in single-day inflows, the largest in the fund's 2-year history. Analysts project total Bitcoin ETF assets could reach $180 to $220 billion by end of 2026 as major wealth managers integrate distribution. Bank of America's $3.5 trillion advisor pool now recommends Bitcoin ETFs. Vanguard reversed position and offers Bitcoin exposure to 8 million clients. Wells Fargo opened distribution. This isn't fringe adoption. This is mainstream finance capturing cryptocurrency through traditional product packaging. Meanwhile, Bitcoin itself trades around $90,000 in mid-January 2026, and approximately 60% of all Bitcoin is held on exchanges or in institutional custody, not in self-custody wallets. The peer-to-peer electronic cash system has become a store of value asset most holders never touch, never use for transactions, and never control through private keys. The irony is devastating. Bitcoin's price success made ideological purity impossible. When Bitcoin hit $1,000, then $10,000, then $60,000, the focus shifted from technology and sovereignty to investment returns and speculation. Forums that discussed cryptography became price prediction channels. HODL went from ideological commitment to holding for gains. Number go up became the mantra. New Bitcoin buyers in 2020 to 2026 don't care about sovereignty, they care about returns. They're perfectly happy buying ETFs, leaving coins on exchanges, and trusting institutions as long as price increases. Wall Street recognized this and optimized for it. Make Bitcoin easy to access, eliminate technical barriers, provide familiar investment vehicles, charge standard fees. The revolution became an asset class. By January 2026, exactly 2 years after ETF approval, the transformation is complete. Bitcoin trades like any other commodity. Wall Street controls distribution and custody. Fees extract hundreds of millions annually, and the peer-to-peer cash system functions primarily as speculative investment accessed through traditional financial intermediaries. This is the empire economy. Bitcoin's white paper promised peer-to-peer electronic cash without financial institutions. 18 years later, BlackRock and Wall Street firms control over $128 billion in Bitcoin through ETFs as of January 2026, charging 0.25 to 1.5% annual fees for holding cryptocurrency designed for self-custody. The capture happened through predictable stages. Exchanges created trusted third parties solving self-custody difficulty. Institutional custody emerged to meet regulatory requirements. ETF approval in January 2024 made Bitcoin accessible through traditional finance, maximizing Wall Street control. 2 years after ETF launch, results prove complete capture. BlackRock's IBIT holds 784,000 Bitcoin worth $70 billion, extracting $175 million annually in fees. Total ETF market holds 6 to 7% of all Bitcoin supply. Approximately 60% of all Bitcoin is custodied by institutions, not individuals. And the week of January 12, 2026, saw $1.4 billion in institutional inflows. Wall Street's strategy was perfect. Dismiss Bitcoin early, allowing adoption and price appreciation. build infrastructure creating dependency on centralized platforms, capture regulatory framework requiring institutional custody, launch products extracting perpetual fees. The pattern repeats across history. Labor unions, environmental movements, punk rock, organic food. Every resistance gets co-opted, commodified, and sold back to rebels enriching the system it opposed. Bitcoin was cypherpunk revolution against centralized financial power that became centralized financial product managed by world's largest asset managers. The ideology was be your own bank. The reality 2 years after ETF approval is let BlackRock custody your Bitcoin for 25 basis points annually. Empires don't fight what threatens them. They wait for adoption, build infrastructure capturing distribution, create regulatory frameworks requiring control, then extract fees from the thing that was supposed to destroy them. Financial revolution doesn't eliminate intermediaries. It creates new intermediaries extracting traditional fees from revolutionary technology. Wall Street lost nothing. It absorbed Bitcoin and turned rebellion into another profit center, generating hundreds of millions in annual fees. And the final joke is Bitcoin holders in January 2026 celebrate $90,000 prices and record ETF inflows, while paying Wall Street billions cumulatively to hold assets designed to eliminate Wall Street, proving that in empire economics, even revolution becomes extraction once revolutionaries prioritize returns over ideology and convenience over sovereignty.